Carol Roth, welcome to the program. How are you?
I'm doing great, Glenn. I'm actually celebrating my 26th wedding anniversary today,
gosh.
so it's a blessed day.
Oh, well, congratulations. Congratulations. You know, it's weird. I'm coming up on my 26th in January. So,
fabulous,
yeah.
fabulous. It's a good amount of time to be married, for sure.
It is. So, Carol, let's talk a little bit about the price of gold hitting, what is it? It's
over 4,000.
Over 4,000, which is nuts. And I don't think people really understand. I don't think the average, this is my guess, and I want you to correct me. I don't think the average person is buying gold. I think this gold buying is happening from sovereign funds and central banks, mainly, also Asian markets. I don't think Americans really understand what $4,000 an ounce means. Can you explain it?
Yeah, absolutely. Obviously, I think that the world, both investors and central banks, are catching up to the things that you and I have been talking about for years.
Yeah.
So, we were ahead, we warned everyone, and now this is a little bit of catch-up. Interestingly, as you noted, the average American is very behind in terms of what gold means. When you look at Chinese households, when you look at Indian households, there are estimates that each one of those countries' households owns about up to 30,000 tons of gold at this point, which, to put that in context, the U.S. government owns 8,133 tons.
So now, the Indian households, all of them combined, 27,000 tons.
Right.
What we say we have is 8,100.
Right.
Wow.
So the households in China and India are really ahead of the curve. When you look at data for the U.S., it's a little bit hard to get good data, but from what I've seen, the estimates are only about 10 to 11% of U.S. households at all have exposure to gold. Now, I know that your audience is very sophisticated and is ahead of the curve, and I would imagine blows through that number, but just shows how sort of unprepared U.S. households are, in general.
When you're looking at Indian and Chinese households that own gold, does that include all the gold jewelry? And
yes.
Yes. Okay. All right.
Yes. That's actually particularly in India, of one of their preferred ways of procuring gold.
Okay. So gold has shot up over $4,000 in record time. I mean, breathtaking time.
Yes.
What is causing that?
Okay, so there are a confluence of factors, and I think the two most important factors, which of course are linked, are what Wall Street is now calling the debt debasement trade, which they've just caught on to and gave it a cute name, and the changing global financial order, and those are very much linked. So we'll go into each of those.
Tell me what is it, the debt debasement, what is that?
They're calling it the debt debasement trade, which is just basically what you and I have been talking about, which is our unsustainable fiscal position.
Correct.
And what all of the money printing that we've seen over the past 17 years, what that has done to our purchasing power and how that is going to catch up to us. So as a reminder, our debt to GDP is at emerging market crisis levels. We're 120+% of GDP. We're running deficits that are equivalent to a wartime level or a recession level while we still have growth, which is crazy. We have interest rate that is outpacing defense, or interest payments that are outpacing defense spending. So everyone is now finally catching on to the fact that this is an unsustainable financial position, and it is going to be very difficult to get out of without there being some sort of additional debasement of our currency, which is a fancy way of saying a diminishment of your purchasing power. What's really crazy, there's a chart that's been going around, and they did kind of a comparison of different asset classes priced in U.S. dollars and priced in gold. So if you look from the end of September 2018 out 7 years, and you look at the top 100 NASDAQ non-financial companies, it's called the NDX, in U.S. dollar terms, that is up 236%. So you think you're super rich, right? But in gold terms, solid money that doesn't have its value debased, it's only up 4.7%.
Oh, my gosh.
Wait, it gets worse. The S&P 500, up 133% over that period in dollar terms. It's down 27.6% in gold terms. And the what's called the Case-Shiller Home Price Index, which is the value of homes, the way that's measured, in dollar terms up 60%. We're all saying, houses so expensive. In gold terms, it's down 50%. In fact, right now, it takes less gold in terms of ounces to buy the median single-family house than it has in decades and decades and decades. So it goes to show that even though we see these dollars, they're buying less and less. And now, you and I have been talking about this forever, but now Wall Street is catching on, that's not a great thing. And so in terms of preserving the hard-earned capital, we need something that is that hedge, that neutral hedge that's going to retain its value. And that's why more investors, institutional investors, funny enough, a lot of millennials, more than anyone, starting to really get into gold.
You know why? Because millennials have not been trained their whole life. Trust the system.
Yes.
And they see it clearly. And they look at it and they're like, well, this doesn't make any sense at all. You can't spend this and, you're going to wreck the dollar and everything else. They just see it without being trained over and over and over again that, oh, no, trust the system. They don't trust the system. And once you realize that system is rigged in a million different ways and the system is not telling you the truth, that is amazing. When you look at the stock market and you say it's actually down when you compare it in U.S. dollars to gold, what's happening is, let me explain this to the audience. What all that means is gold is only going up in dollars. It's staying stable.
Yes.
But it's costing you more because of inflation. The dollars are buying less, so it looks like you're paying more, but you're really not. It looks like the stock market is going up, but it's really not. It's what it costs to get in with dollars. If you were going in with gold, you'll actually see that if it was all done in gold, the stock market is down. The price of housing is down. It's the dollar. Takes more dollars to buy than it does with gold, which holds its value. That if people could understand that one thing, that changes all of the conversations of the government's got to do something to make housing more affordable. No, they don't. They have to stabilize the dollar. They have to stop spending so much money.
Yeah, if you think of the three definitions of money, it is a medium of exchange, how you help to exchange goods. Yep. It's a unit of account, which we say things are priced in dollars, and it's supposed to be a store of value. The unit of account that you just talked about, my friend Steve Forbes has a great analogy, and he talks about other measurements. Imagine that your clock, one day, at 12 o'clock, means midnight, and another day, 3 o'clock means midnight.
Right.
Or 6 inches to measure a curtain one day, and then the same measurement is like a foot a different day. Right. You can't have a consistent measurement if the unit of account continues to change. And that's what we've been seeing here with the dollar. And unfortunately, it has not been to our favor, which means that when you work really hard to earn something and it's valued in $1, that over time, that work that you've put out, your productivity is worth less and less. And so what gold is meant to do, it's meant to be capital preservation. It's not a risk asset. It's not meant to take on risk and maybe go up a ton and maybe go down a ton. It's really meant to be a counterbalance to what you have earned so that you can preserve your purchasing power.
I've been saying this for a long time that you put your money, and I have money in the stock market, but you put your money in the stock market. If things really go awry, go ahead. You're going to cash out for an awful lot of money, but those dollars, it's going to be paid back to you in dollars. Those dollars will be worth less, even though there's more of them stacked up, than that ounce of gold or that, 10 ounces of gold or whatever you had. The stock market is paid in dollars, so as the inflation goes up, but gold keeps its value. keeps its value and holds it steady. So yeah, you're going to be paid more in dollars if you try to sell your gold, but that's going to continue to increase while stock markets will go down. Am I right?
It's a counterbalance. So if things were to shift, and for some reason, things were to change with the dollars, which would need a lot of different catalysts, and then your gold goes down, it's a counterbalance, which is why it's important to have that diversification in your portfolio and to have the gold hedge. What's interesting, Glenn, is just the history. We're talking about millennials. They went through the Great Recession, financial crisis. They're kind of keyed into this. But if you think about when we came out of the 70s with this crazy inflation, we came out of the gold standard, it used to be very commonplace for a financial advisor to sit down and say, okay, we've been through this, and so you should be putting 5 to 10% of your portfolio in gold. As the stock market took off in dollars and became this big thing and they started seeking fees, that went away. And financial advisors who don't get paid sometimes at all when you allocate to gold stop recommending it.
Yep.
And now we're seeing a shift back. Now we're seeing, oh, yes, you should have some.
I hope.
Some of the big names out there are saying even more. And
Ray Dalio just came out and said 15%.
Yes, we've seen from big names like that anywhere from 10 to 20. And when they surveyed high net worth investors, which are $250,000 or assets or more, they're averaging right now 21% of their holdings in gold.
Wow.
So a very big flip in recent years on how this is being viewed by the people who have accumulated those dollars and are worried about them.
Okay, so let me just summarize here before we move on to some other questions. That is exactly what my grandfather, who lived through the Depression, said. What are the people with big, large amounts of money doing?
Yeah.
I want to do that, and if I would have done that, I would have been better off in the Great Depression. You just heard it. 20% or more, right, for big dollars, they're investing in gold, 20%. You should have some.
And it's interesting, some of the portfolios we're seeing, some of that is coming not necessarily from the equity piece, but from the fixed income piece, which is pretty interesting, too.
Amazing.